Hello, everyone. This is Erica Dagnan-Minahan, and I just want to welcome you to Angel Investor Training with 1000 Angels. I can see we have quite a few people here. I want to thank you guys all for joining. Give everyone a minute to get online and tell you how excited I am to be doing part 2 of Startup Valuations Explained for the group. So I know that quite a few of you are new this week and you missed Startup Valuations Part 1 that we started last week. So I'm kind of gonna, do a little bit of a recap of some of the things that we discussed in the previous session for those of you who missed Part 1. But if you did miss Part 1 and you're here today and you want me to send you a recording, I am happy to do that. Hi, Ron, how are you? Nice to see you as well, too. So the other little housekeeping tidbit that I have for all the folks today is that I would love for this session to be extremely interactive. So if you've joined us by your computer, please feel free to use the chat function, to use the Q&A function. As I'm kind of going through the slides, it'll ping me and let me know that you have a question or a thought that you'd like to share with the group, and I'm happy to read that aloud and address any of your questions. Hi, how are you? Nice to see you. So thank you guys all so much for joining. And just to give you a little bit of background on 1000 Angels, for those of you who are new to 1000 Angels, welcome. 1000 Angels is the premier membership network for folks who would like to start building an early stage investment portfolio the easy way. So we do a lot of work with our members, helping to source and present them with really exciting early stage direct investment opportunities, and really to establish themselves as angel investors in their own right through direct investments. So if this is your first time, welcome. If you have any questions or want to learn more, feel free to reach out to me, Erica at 1000 Angels, and I'm happy to tell you more about 1000 Angels. Great. Hi, Aaron. Thank you for the question. Is it as well for solo teams? I'm not 100% sure what that question means, but you can email me and we can get into the details of that maybe separately. So speaking of, I'm just gonna kick it off and jump into the slides and share my screen with everybody. Hold on a second. All right, great. So hopefully everyone can see the screen. This is kind of midway through our actual presentation on startup valuations. The intro slide is not at this point, but I will give those of you who are new a little bit of background on myself. So my name's Erica Dagnan-Minahan. I'm founder and managing partner at 1000 Angels. I've actually been investing in seed and Series A for the last 13 years, spent 8 years before that on the public market side doing traditional investment banking. But once I got into early stage VC, I really fell in love and have been doing it ever since. Since then, I've invested in hundreds of early stage startup companies through various roles as executive director of other angel networks, as well as a member of the GP for the Dream It Ventures Fund too. So a lot of experience investing in startups, but also working very closely with startups from a very early stage. So this has given me all of the sort of experience and information that I need to help guide you guys through your journey as angel investors or as founders who are interested in learning more about what angel investors think and how we think about valuation and other topics. So really, the big question here that we're trying to determine is what factors actually drive startup valuation. So we've seen, so many sorry, just went ahead a little bit much. So we've seen so many companies get into the press over the last, I want to say 5 or 6 years. It's become really fashionable for companies to be highlighted because, they have a $1 billion valuation, or they just, closed an investment at a $2 billion valuation. And of course, these things are pressworthy because it, seems like a really big, exciting number. But when a company's at the early stage, say seed or Series A, what are some of the factors that we're basically relying on to help establish whether or not we feel that a company should have a higher valuation or a lower valuation, and what are sort of the valuation ranges that you can expect for companies at different stages? So if we look at some of the basic high-level bullet points of what actually drives value, most early stage investors will tell you that the number one driver of value at the very early stage is a strong management team. And I think that one of our attendees had asked something about, he said solo teams, but he might have meant solo founders. This is one of the reasons that you're always going to hear that it's so much harder for solo founders to get funded, because a strong management team is an absolutely essential just data point when it comes to establishing value for an early stage company. The second thing, of course, is the size of your addressable market. So the larger the market opportunity, the greater potential for a very large exit for your business, the greater value that investors actually see in a company. So, a business that has an addressable market of 10, 20, $30 billion is going to be considered a lot more valuable than a company that is maybe addressing $1 billion market. So not only sort of the size of your market matters, but how well that market is actually being addressed. So if it's a new market or a growing market that's quite large and doesn't have a lot of established players, that will actually push upward on the potential valuation for an early stage company. And then when we look to some of the other criteria that are more specific to the actual business metrics themselves, investors are really going to be looking for, do you have evidence of product market fit? Do you have proven customer acquisition channels, and are they scalable? Do you have any sort of competitive advantage or intellectual property? And are there any barriers to entry that will keep competitors from coming into your market? And if not, do you have some sort of a sustainable first mover advantage? We've seen capital intensive companies like Uber be able to actually sustain pretty high valuations with that first mover advantage, which still left room for multi-billion-dollar second mover entrants to come into the market. And then lastly, what sort of traction do you have? So traction essentially is just whatever key performance indicators or KPIs that you have that establish that your business, has some evidence of possible success. So that's what we consider traction. It completely depends on your type of business, what metrics you feel establish traction for you, but it shows that you've made some really positive progress in the business and you have the data to back it up. And then, of course, what is the growth potential? And then lastly, a very key and very fundamental driver of value is the potential for exit. So if we know that in your particular industry, there are a lot of cash-rich acquirers, that will also actually drive up valuation for your startup. So Rohan has asked a question, could you elaborate on first mover advantage? And so first mover advantage just means, for example, in the meal kit industry, right? Some example companies. So, right, so Uber was one of them. So, Uber was the first, mover in, app-based ride industry, the first really successful one anyways. I'm not even sure if anyone, legitimately tried it before. And they had a very solid first mover advantage, but of course there was still room for companies like Lyft, et cetera. If you look at, for example, the meal kit business, when Blue Apron and HelloFresh and some of those early movers came in and plated, they were able to take a big share of the market. And of course, they didn't really have barriers to entry. There are plenty of other meal kit companies that have tried since then, but they didn't quite have the same advantage. So that's what we mean by first mover advantage. Thank you for that great question. So when we talk about what factors of management team actually drive value for a startup, so number one of the biggest drivers of value is experienced or serial founders. I was actually teaching this session at Chief last night, and somebody said to me, well, you know, that's not fair. If we're only going to give money to, thank you, Douglas. I'll look at your question in 1 second. So if we're only going to give money to, you know, successful founders, how would any new founders get funded? And I said, well, you know, experienced or serial founders does not necessarily mean that they were previously successful. And the reason that this actually adds a lot of value is that there is a huge amount that people learn just by doing one startup, you know, even if the startup is not successful. So, and when we say successful, we mean, you know, providing a positive return on investment. In the angel space, you know, we see that somewhere around 30 to 40% of startups, you know, end up not returning any capital to investors, end up as a total zero. Another 30 to 40% might actually allow investors to break even. But it's really only about kind of 20 to 25% that provide, you know, those that are really considered successful and provide attractive returns. So knowing that, you know, this is kind of the landscape of what outcomes are for founders, you know, there's still a lot of value for a founder who maybe tried something before, it didn't quite work out. You know, he was maybe able to return some capital to founders, but, you know, it wasn't an amazing success. The learnings that they bring from that previous experience still are able to add a tremendous amount of value to their next project. So you'll see experienced founders getting a little bit of credit for that. Of course, people prefer to have several co-founders versus a solo founder. And we love to see a team in place. You know, ideally it's at least 3, and depending on what type of business it is, people basically want to see, you know, a CEO, a COO, a CTO, or a CMO. So whatever 3 out of 4 of those is most sort of attractive for your business will provide a lot of points in terms of valuation. And then most importantly, just relevant expertise, right? To really be able to answer the question, why this team? You know, I look at thousands of startup pitches a year, and sometimes, you know, the people who are presenting the idea have no relevant experience at all. You know, I had this one guy who was pitching me and said, you know, he really wanted to start a company in digital marketing. He just needed to find somebody who actually like knew digital marketing, right? So it's like, okay, that's a very extreme example. But, you know, the team needs to have a relevant expertise that's valuable. And then, of course, their sweat equity. So what have they built so far prior to funding or with friends and family money is a huge driver of value. So I'd love to go to Douglas's question. Can you touch on timelines on these factors where the longer they take to reach or execute, the less attractive the company becomes as the factors become stale? Yeah, Douglas, that's a really, really wonderful point. That absolutely does happen. So, you know, truthfully, if a company has been around, you know, for a couple of years and they've, you know, not been able to achieve these milestones, it becomes less and less attractive to investors because investors have less and less confidence in the team's ability to execute. So time really is of the essence. I think once you put a product into the market and start fundraising, or once you start building a business, period. And, you know, that's kind of an unfortunate reality because you know, it's very interesting. I co-teach at Columbia Business School, the Lean Launchpad with Steve Blank, which we just did in January. And he had a slide that I absolutely love and should probably throw it in here. But, you know, a big thing that founders and investors don't realize sometimes when they say that they're looking for companies with hockey stick growth is that, you know, there is a flat part of a hockey stick. It's not all just, you know, the handle. There's a whole flat part that you actually use to score the shot. And people aren't always aware of that, of the fact that, you know, it realistically does sometimes take 3 to 5 years before a company really gets to that inflection point where they now have the type of growth that's attractive to investors. So it's a really great point. You know, it's not realistic to expect that every company is going to take off right away, but it is something to think about that, you know, going stale will reduce value. So if we look at addressable market, how does that drive value? So first of all, your total addressable market needs to be at least $1 billion, and that's because this is essentially going to dictate, you know, how large the company can grow. For a company to be investable, you really need to get to at least 100 million or more in revenue. You also need to leave room for growth potential after the exit. So a large addressable market and a growing addressable market is preferred. That's why you've seen people get so excited about cannabis and, even crypto for a while. All of these markets that were considered fast growing were a lot more attractive to investors, I would say, even in an irrational fashion. We have a deal that we're working on at 1,000 Angels right now. We have a great deal that's in the video space. As you can see, people are doing so much more video now. They need really high quality video. So, hugely exploding market. We're seeing a lot in Internet of Things. Everybody, wants connected devices. So a market that's large but also growing will also add value to an early stage company. So the most important thing, though, I think, to really establish value, and essentially this is one of the key things that will help get you as a founder to a Series A, and will also, make a company much more attractive as an investor, is to prove that you have product market fit, right? So if we think, why is product market fit so important, and why is it so misunderstood, and why do people end up in less favorable situations as investors by making investments in companies that don't have product market fit? Well, very simply, if you've ever seen one of these surveys, right, that asks you, how would you feel if you could no longer use product X? The reason that you're getting it is so that the company can establish their level of product market fit. And so, for example, a really successful company here, we have an example of Slack, has amazing product market fit. And as you can see here, it's a very simple question. How would you feel if you could no longer use the product, right? It's not how do you feel about this product, but how would you feel if you could no longer use it? And we can see that over 50% of Slack users say that they would be very disappointed if they could no longer use Slack. And then another close to 40% say that they would be disappointed, like somewhat disappointed. So, if you have sort of 90% of your users saying, hey, I'd actually be pretty disappointed if I couldn't use this anymore, that you've achieved product market fit. And this is a really tough thing to achieve. Your consumers have to basically feel pain if you're not available. And that's a great way to indicate that not only do they actually really like the product, right, that you're thinking about investing in, but they also don't have an idea of a really sort of easy or great substitute, right? So losing it would actually cause them some pain. So it's so crucial to value because, number one, as we said, it establishes that they actually value the product, and it establishes a good possibility for monetization. So even if the startup that you're looking at hasn't necessarily turned on revenue yet, Facebook is a great example of that, right? When they first started, they took a long time to figure out their revenue model and actually turn on revenue. But if you had done a similar survey among Facebook users, even before they figured out how they were going to monetize, you would have seen that, probably like 100% of users would say that they would be very disappointed if Facebook left tomorrow. And the reason that as an investor, I think that, making sure that the company has some evidence to establish product market fit is because if there is no product market fit, you will invest in the company, and what will happen is the company will invest that money into growth, into customer acquisition, and then users will churn because they just don't care enough about the product. So I am going to go to the Q&A really quickly. Let's see here. Trying to see if I can see the questions. Sorry guys, I can see, for some reason I can see the chat panel. I'm having a little trouble seeing the Q&A. Oh, here it is. Okay. All right, I'm just gonna really quickly answer the questions that people have had. So the first one is, will you be sharing this deck? I absolutely will share the deck with folks afterwards. So you've got that, Leon. Rohan asked, what are measuring points of successful sweat equity that founders have put in? It's really just going to be on a case-by-case basis. So, if the company, has a CTO founder and, for example, they've already, built all of the code, right? So that's some pretty valuable sweat equity versus, a company that's more marketing based with a CEO, COO, and CMO, and they say, hey, we've got this great idea, we've validated demand, but we're going to take, part of this and use it to go hire an outsourced development firm to actually build the technology for us, right? So that's a great example of, the company that's already built the product in-house is going to get a lot more sort of valuation ascribed for their sweat equity and the work that they've done. So Dan asked, how significant is the family and friends round if founders invest their own capital in addition to sweat equity? So I would say the friends and family round is important because it's great signaling. What it tells investors, is that, listen, this founder has been able to convince, people that they're going to see at Thanksgiving dinner and hopefully people that they want to be friends with again in the future to actually put money into this company that is probably behind your investment, right? So that number one, people who know the founder really well, trust them enough to make an investment in the company. And number two, they're going to have, a strong obligation to feel that they want to work as hard as possible to make the business work and provide a return to investors because these are people, that they have a personal relationship with. So it is important. Now, I will say that, unfortunately, folks who, have grown up in communities where they don't, have a lot of money, their parents don't have money, their family doesn't have money, they don't know people who have money, are obviously at a disadvantage in this particular scenario. And so it should not be held against them. But, as an investor, you should sort of use your own judgment to see, how valuable you think that is to you. One of the things that, over the last decade has kind of somewhat been able to replace friends and family rounds for people in that situation is, of course, participating in accelerators or incubators that provide, the first kind of $100,000 in cash. So Leon asked for the slide regarding Slack, were the users a random group of people, including no, so it was only Slack users. So you only want to ask about the product market fit to your users. So that's something that basically pops up while you're logged in to collect the data. And so Matt asked, in seed and angel rounds, who should be dictating the term sheets, founders or investors, who has the most influence? This is a great question because I very often see sort of founders randomly coming out with term sheets. And I guess the answer to that is, it's always best if the investor sets the terms, right? But the problem is that in order to get an investor to sort of properly set terms, it usually has to be an experienced investor and it has to be somebody, who has a good understanding of the market. So sometimes when a founder is doing, more of a real sort of friends and family / angel round, they might put together a convertible note and sort of establish their own valuation. The thing that's pretty much okay there is that, outside of whatever the valuation cap is, the structure in terms of both SAFEs, which is the more common security now, that stands for Simple Agreement for Future Equity, as well as convertible notes, is pretty standard. It's basically saying, we're not establishing a lot of rights and terms and restrictions right now. We are going to establish a valuation cap, but this is going to convert into a security at whatever terms are negotiated when the company does a qualified financing of, say, $1 million or more. So ideally, the terms and valuation at each round should always be set by investors. If you're a founder and you're not sure, you should definitely at least speak to as many investors as possible to get some guidance on what they think your valuation should be so that you don't accidentally misprice around by doing it yourself. So if we move on to sort of a next, big driver of value, it is the customer acquisition channels, right? So the simple rule of thumb for whether or not, an acquisition channel is actually valuable is that the cost of customer acquisition should be less than, should be about 1/3 or less of the customer lifetime value, right? So we want to make sure that if it costs us $30 to acquire a customer, that we are going to get, at least kind of $90 in customer lifetime value. And when we think about the ratio there, what we want to ensure is that we're able to invest in acquiring a customer, but also recoup that money within a reasonable period of time. So, you know, there are two factors that are sort of important, right? So one is the CAC to LTV ratio. So if it costs one company A $10 to acquire a customer worth $100, that company is more valuable than a competitor who needs to spend $50 to acquire the company that's worth $100. Likewise, a company that, you know, recoups that $100 on the first sale is much more valuable than a company that takes, say, a year to recoup that $100 because it's a, you know, $10 a month subscription product. So those are some of the ways that the CAC to LTV ratio can help drive value. And of course, you know, if there's actually, this is sort of like a software company metric, but if there's cost of goods sold or product margins, you have to factor that in as well. So that was kind of all of the recoup from the previous section. So if I rushed through it a little bit, sorry, we go into it in a bit more detail in the recording. So if anybody wants the recording from session 1, you know, let me know and I'll make sure that you get access to it. But now we're going to sort of dive into the nitty-gritty, which is, you know, understanding the math behind all of these valuation methodologies and the numbers. So valuation methods will typically differ by investment type, right? Investor type, stage of investment, and also just availability of capital. You know, when things are kind of booming like they have been, and I want to say it's been at least, yeah, I guess probably the last, let's say 8 years, 9 years, there's been pretty robust availability of capital. When there's not, you know, sort of all bets are off and valuations can swing wildly. But, you know, investor type, stage of investment, all these things and size of investment are really going to determine where you fit in. So the types of investment that we look at when we sort of consider, you know, different categories for a company's funding life cycle is, you know, at the seed stage, you know, there are some methodologies that we'll go over. Rule of thirds, I don't really see that used a ton anymore, but we'll go over just so that you know. Deferred, right, which is basically a convertible note, we'll think about it later, and the Berkus method. So all of these are kind of, you know, typical valuation methodologies that like true angel, you know, true pre-seed, early seed investors have used. And then when you get to Series A, you know, we primarily use what we call like the venture capital method. So that is much more based on sort of really sort of a discounted future cash flow, but basically the fund is looking for a certain cash on cash return multiple, right? And then of course, you know, comparable analysis, benchmarks can also be applied at this stage. It isn't until you get to sort of like the growth stage that companies will start looking at multiple of revenue, right? And basically, most of these growth stage equities are also looking to acquire a control stake in a company. So they want to own 50% or more. So it also changes the way companies are valued. So I do get a lot of folks who have a background in, you know, say investment banking or in public markets, you know, who are like, oh, like how do I'm going to go on PitchBook and look for the comparable company analysis and find out what multiple to apply to my startup. Like we don't actually even start thinking about multiples until the company's, you know, in the growth stage. So, you know, $20 million plus in revenue, and sometimes, you know, not even for that. Prior to that, it's very much case by case. There are just a lot of sort of non-balance sheet income statement factors that need to be looked at. Then when you get to private equity, people are definitely looking at multiples. They're using discounted cash flow analysis, like proper discounted cash flow analysis, and net present value of future cash flows. And then by this point, the company actually has some assets, so they're valuing it based on assets. And this is more typical to how things are valued in the public markets that people are much more familiar with. So there's some overlap, but as you can see, you know, it has a lot to do with the fact that at the seed, Series A, and even at the growth stage, the actual future cash flows are so much more uncertain. So we're really not sure, you know, saying that you're going to do a DCF on cash flows that are so uncertain is not really a great way to base a valuation. Okay, great. I think I had another couple questions that came up. Great, I have one from Hannah. Can you give us an opinion of crowdfunding and how it fits in? So we'll talk about that a little bit later. That's a great question, Hannah. So Leon says, if getting $100 immediately is more valuable than getting $10 per month, why are SaaS companies the holy grail? Well, for a few reasons. So let me put it this way. Getting $10 a month is preferable to getting $10 immediately, right? So even with a SaaS company, you know, why do you think so many SaaS companies are trying to like push you into, you know, purchasing an annual subscription versus a monthly one? So SaaS companies are the holy grail because they just tend to be stickier. And then also for sort of like unit economics, you know, you can bring on additional customers without usually having to spend a lot on sales, and there's very little cost of additional customers. So that's kind of why SaaS companies are so attractive to investors. But if you have a SaaS company and, you know, it costs, you know, I don't know, $30 to onboard a company, you'd much a client, you'd much rather that when you spend your $30 that they pay $100 for an annual subscription than when you spend your $30, they're now spending, you know, sort of $10 a month, right? So subscriptions are valuable, but the faster you can recoup your customer acquisition cost, the better from a cash flow perspective. Aran asks, what is too early for a company to get investment or even the right time to start pitching? So, you know, I would say that it's going to be really difficult to get investment before you have some evidence of product market fit or some really good evidence of traction. You know, I never say impossible because anything is possible. But, you know, if you're still sort of like trying to figure out what your product is and why people love it, that's not the best time to bring in external investors. Because as soon as you have external investors, essentially, they're going to be putting a lot of pressure on you for growth. And if you don't yet have product market fit and you start investing in growth, then you're just going to deal with churn and it's going to kill your company. So from my perspective, I would say, you know, it's much better to sort of figure everything out, you know, not on a VC's money, because otherwise there are just too many traps and too much danger. So, you know, when we're determining valuation at the early stage, it is both an art and a science. You know, the important thing to remember is like, there isn't such thing as like a company has a valuation. It's a negotiation. It's always just a negotiation between the founder and whoever the lead investor is. So, you know, it's going to depend on a lot of things. And, you know, most importantly, we want to make sure that when we're setting a valuation that we're considering sort of, you know, the long view for the company's cap table, you know, that we're using a methodology that makes sense. And that most importantly, we're going to be able to sort of meet the entrepreneur's needs, right? So too high is bad, too low is bad. So how do we kind of find that Goldilocks area to be? So this chart just explains one of, I think, the most misunderstood concepts for new investors, and even for startup founders, is just, you know, why do we always talk about investment from the perspective of pre-money valuation? What is the difference between pre-money valuation and post-money valuation? Now, this is like really, really simple math, but people don't always understand it because it's not something that exists, you know, in the world of public market investing. So you could have been investing in stocks for the last 20 years and you would never have come across the concept of pre-money valuation. So the pre-money valuation is the value that's ascribed to the company before the investment comes in, right? And then whatever the total investment ends up being is, you know, what's referred to as the new money. And then the post-money valuation is just the pre-money valuation plus the new money. So the only money that is real here is the new money. That's like actual money. The pre-money valuation is just whatever number we made up and we agreed on that we believe represents what the existing stakeholders' share of the company should be based on the new money that's coming in. And so the post money is you add the two together. So in this example, the pre-money valuation, this would be, for example, a pretty early stage company that needs to raise $1 million. The new investors say, great, we want to put in $1 million. We think that this company is worth about $3 million. So after the investment, the post money on the company is $4 million. And the reason that we have this is because when a startup at this stage is raising $1 million, it's very unlikely that the round is going to be exactly $1 million, right? So it will either be something a little bit less, it could be as low as maybe they only end up raising 750,000, right? Maybe they end up raising 1.25 million. So whether it's a little bit under or a little bit over, you don't want sort of the value, the founder's stake value to change based on the total amount raised. It helps keep sort of the ownership per dollar stable for the new investors, regardless of whether or not, the deal was like slightly oversubscribed or slightly undersubscribed. So we always want to talk about valuation in terms of pre-money valuation, not post-money valuation. So if we look at pre-seed funding, and this is more for common stock, which is pretty unusual, the old school methodology, what was called the rule of thirds, and I would actually say it's probably more like the rule of fourths, because in any particular round, you don't really want to give up more than 20% to like 33% of the total equity. And this was kind of a model that was pretty common in IP commercialization type businesses where there would be, founders, right? People that sort of maybe created a technology that needed to be commercialized, management that was brought in to actually run the business, and then investors that came in. And the rule of thinking was kind of like, okay, well, we'll just divvy it up in thirds. I would say that nowadays, founders and management are usually the same thing. So the idea is that, usually in any particular round, investors are going to end up with somewhere between 1/4 and 1/3 of the total equity in the company. And I would actually say even more like between 1/5 and 1/3 of the total equity in the company. So that's kind of where that rule comes from. And so the amount of, cash that you can raise ends up being sort of limited by what is 1/5 to 1/3 of the value that your company has actually built so far. So I am just going to really quickly check for questions in case anybody has some. And let's see. Okay, looks like we're good. Nobody's in the chat with new questions. Actually, sorry, Iran asked, is the pre-money without revenue? Yeah, so pre-money is just the pre-money valuation of the company, like nothing to do with revenue. None of these things are based on how much revenue the company has. This is more just saying, what percentage of equity are the founders willing to exchange to investors in exchange for cash? So pre-money, post-money valuations have really nothing to do with revenue. They have to do with the amount of money that's invested. So the method that we actually use at 1,000 Angels, which is the more standard method, is the venture capital method. That's what we use for every single deal. And if you're a member of 1,000 Angels and you look on 1,000 Angels, we have a calculation for every company that illustrates what we think the cash on cash return and IRR of this investment can be based on the company's financial projections. So essentially with the venture capital method, what you're doing is you are trying to estimate the terminal value of the company based on some sort of a multiple of sales or expected EBITDA. Because things have gotten so crazy in the last few years, almost everybody, is doing revenue multiples. In the olden days, people actually cared about EBITDA, and even for public companies, it's sort of gone out the window. So folks are a bit more focused on revenue multiples, but will also adjust those based on the type of company it is. So a revenue multiple is going to be higher for more of a technology or SaaS company. It's going to be much lower for something that's in the consumer space. And depending on where you are in between, it sort of varies. But we want to think, okay, if we're going to exit in 5 years, what do we think this company is going to be worth based on the founder's financial projections? So if the founder has said, I think that by year 5, I'm going to be doing, $200 million in annual revenue. And we think, great, we think that, if this company can get to 200 million in annual revenue, at this year, and it sells, for 5 times revenue, right, then it's going to be worth $1 billion, right? There's a potential for $1 billion exit. So we kind of take those projections and we say, what do we reasonably think the company could sell for? If you don't think the terminal value of a company is going to be at least kind of like 150 to 250 million, by year 5, it's probably not a good idea as an investment, because you need the company to get to that level of scale in order to actually have some sort of liquidity event, right? So it needs to grow large. So that's why we care about that. You also need to take into account the amount of equity that needs to be invested into subsequent rounds, right? Because that creates dilution. So we take all of those factors, okay, and we calculate an IRR based on the number of years to exit, and we'll just, do that based on however many years of financial projections the company's provided to us. And using those figures, we're looking for a cash-on-cash return of between 10 and 30x, right? So what you really need to think about as you're making an investment is, do I reasonably think that within the next 5 years, the company can sell for 10 to 20x the post-money valuation, right? So what are the odds that that will happen? So, if, you're coming in and you're saying, okay, the post-money on this round is $10 million, do I have confidence that within the next 5 years, this founder could sell this company for 200 million or more, right? To account for the dilution that I've experienced. So that's really kind of what we do. And, like I said, you do put together a spreadsheet and, actually crunch the numbers with Excel. But the basic rule of thumb is whatever the post-money valuation is, multiply it by kind of 10 to 20, depending on the stage of the company. And, think, is it credible for a company to actually sell at that stage? And that'll give you some sense of whether or not the valuation is within the realm of reason. So, okay, sorry, I thought I had one more question, but I do not. All right, great. So moving on, if we look at some examples just to show you, deals that we're seeing in the current market. So these are, actual open deals on 1,000 Angels. We'll take a look at a few examples. So one is a really great SaaS company that we're working with right now, raising money for, that is in the video technology space, right? So, they've gotten from 0 to 650K in ARR in less than 12 months. So that's amazing, right? I forget who it was, Douglas, or one of you guys asked me a question about, how long should it take these companies to get to, a growth, sufficient state of revenue. And that's pretty quick, right? So to get to 650K in annual recurring revenue, excuse me, another 12 months shows that they have that traction. And they've already, got some really great clients. They've got clients like HubSpot and 3M and the Muse and, amazing media companies. So we can see, they've also got a patent, right? So if we look at, sort of the original list of things that create value, they've got a patent, they've got substantial revenue. Not only do they have substantial revenue, but they grew their revenue really, really quickly, right? They are sold in all sorts of different verticals, right? So this is video technology that can be used everywhere. So that meets our addressable market. From the addressable market perspective, they've got a growing market, right? I mean, video is already a huge market, but people are using video so much more, and it's so much more perishable now that the market is actually going to get much larger. They've got clients, right? They've got clients that we've actually heard of. And when we look at traction and, user engagement, we can see that their clients have recorded over 5,000 videos in the last 12 months. So we see that evidence of product market fit. So here is the sort of little spreadsheet that we put together to do a quick analysis of, where do we think this company can be, and, how do we feel about it based on the current valuation? Well, we can see here that, their very conservatively predicting to get to at least $15 million within the next 3 years. And so based on the current investment, how do we think about potential exit opportunities, right? So if they could potentially be worth about 145 million, let's just use round numbers for 150 million, and their post money right now is less than 15 million, then it's an attractive investment, right? They've sort of met that hurdle, and that's only within 3 years, right? So within a very short period of time, we feel, okay, do we feel comfortable, going in now at a post money valuation of 15 million or less, knowing that it's highly likely they could be worth 150 million or more within the next 3 years? Great, it sort of meets the venture capital method test. Okay, so that's an example of a SaaS company. If we look at example of another company, and that's enterprise SaaS, right? B2B enterprise SaaS. So if we look at another example of a company that is doing more of a B2C consumer technology, but also SaaS, as people love, let's see some of the things that they've presented to establish their value. So they have built really strong customer, and this is a meditation app, right? Like a live meditation app. So like Peloton for meditation. So they've built a strong initial customer acquisition channel. They have, active subscription enterprise clients. They have B2C and they have enterprise. They've already gotten to more than $1 million in annual revenue. They've previously raised. They have over 10,000 registered B2C members. And they have 6,500 plus monthly active users on the app. So the fact that, 10,000 people have downloaded this app, and out of that, 6,500 are monthly active, is a pretty good indicator of engagement. So it's not like, people are just downloading it and then, it's sitting languishing on their phone, which happens to me with a lot of different apps, but they've actually got evidence that there's great user engagement, and they've built the technology, right? So they're bringing all these things to the table. And of course, both of these companies have amazing teams with, founders that are experienced, right? But we can see, what are the very specific things that we look to that ascribe, value to that startup and really bring value to them. So with this company, similar, they're projecting that they can get to about 35 million in revenue within the next 3 years. And, that may be aggressive. It may not, you sort of have to kind of think, how realistically do I think that this is? And, they're going to have, a post money also probably of actually around 15 million. So we would think, all right, if this company can get to be around $350 million in valuation, right? Let's say we apply a 10x multiple because they're obviously in a very popular and growing market. What sort of cash on cash return is that going to provide to us? So for this one, we feel that, okay, if the company meets their targets and they get to a $350 million valuation within the next few years, that appreciation in value would be about 16x on what we're paying now. And, that's already, companies like Headspace and Calm have already more than exceeded that valuation kind of in a similar time frame. So, all these things are absolutely doable, but we always need to kind of look towards these numbers in order to justify, is the price that we're paying for this company something that reasonably makes sense. And, one of the things that I think that both investors and founders need to be very aware of is that it's very simple. However you establish the valuation for the company right now, if you're at, true seed to Series A, the expectation is that within 5 years, the company's valuation should be somewhere between 10 for probably a larger Series A, or 30 for, an early seed round, times the post-money valuation of the current round. And that's why, we tell folks, be really careful. Higher valuation is not always better, right? You want to have a valuation on your company that gives you enough leeway to be able to continue to raise money in the interim, and to continue to build value for your investors at every round, but eventually sort of meet that 10 to 30x return potential that you unfortunately need in this asset class. So I just want to thank everybody so much who joined today. I want to thank you for the amazing questions. I really appreciated all of the interactivity. I'm just going to really quickly check the Q&A. Okay, great. So it looks like I think we got all of the questions from everybody. It looks like I covered everybody's questions today. You know, we are going to have, oh wait, I think I got one more question that I'll just take a look at really quickly. Okay, oh great, so we have two more questions, actually one more, from Colin, which asks, can I talk about dilution in an investment? Yeah, sure, Colin. So basically dilution happens when there are new investors that come into the round after you invested. So let's say we look at our you know, sort of original example of a company that had a $3 million pre-money valuation. They took in $1 million, and so that $1 million chunk of investors got 25% of the equity, right? What's essentially represented as 25% of the equity. If, you know, 2 years down the road, the company needed to raise $10 million, right? And they raised it at a valuation that wasn't, you know, also sort of 10 times higher than the post-money of your round. What would essentially happen is, you know, there would be some dilution that happens, and that means that the investor stake would be reduced from, you know, 25% to something a bit less to make room for the new investors. So every time there's new money in, the percentage of equity that goes to the new investors comes from both, you know, sort of the common shareholders, the founders, et cetera, and any existing investors. So dilution is actually like quite a complicated topic, and the, you know, equations for it are quite complicated. I'd probably have to do like an entire section like just on dilution for people to really understand it. So who knows, like maybe you gave me a good idea. I'll do a session just on dilution and its impacts, but we probably can't get into it much deeper than that today. But I want to thank everybody so much who joined. Definitely, you know, we will be making recordings available to everybody who participated today, and I'll also be sure to get you all a copy of the deck. If you want to learn more and you're interested in getting involved as an early stage investor, we have some amazing companies available for investment right now. Go to 1000angels.com and join today. If you have any questions, feel free to email me, Erica at 1000angels.com. Happy to find some time to chat with you to answer your questions and help you get started. So thanks everybody. We're doing a session next week on the 18th, so you'll probably get an email from me, and I'd love to see you there as well. Have a good one.